And I mean, the base is in Thessaloniki, but I guess the majority of the people will be there, or you will also have people in Athens?
No, we got a beautiful office now, 5 floors in Athens. So we have to fill it. I think it will be again, how to call it, capital, co-capital situation.
No, I think it's.
And the market is huge. It's 5 million people. There's a huge gap in the market. The players there are not providing, in my opinion, of course, the right experience. So there's a lot of space.
So that's a good hint for everyone listening to us that Instashop will also be available for Greece. It's not going to be just.
It's for my retirement. I can't accept to be in Greece and not order on Instashop.
I don't think it will take that long for you to have the service up and running. But one question is, do you find starting your adventure from a market larger than Greece that has an advantage? I guess we all know the answer, but
it's yes, of course. I mean, UAE is comparable to Greece, and in terms of grocery market size, it's more or less the same.
It is a bit bigger, right? Because of the GDP per capita.
Yes, they're wealthier. They're wealthier, true. But groceries, if I recall it, anyway, it doesn't matter. It's comparable at least. US versus Greece. So, but the reality is that we're talking about the Middle East. It's the same language, similar culture. So we're talking about a much, much, much bigger geography and population that we could tap in, and we are working into tapping in. Whether it's Saudi alone is a huge, huge market with a lot of disposable income. Qatar, Kuwait. So these are very, very attractive markets.
Yeah. No, totally makes sense. Of course, you have access.
But it is an advantage. The answer is yes.
It is an advantage for sure. And at least on the other hand, from our side, when we have startups that start with Greece as a target market, the first thing we all talk about is, when are you going to the next market?
When are you going to UAE?
UAE now is for sure one of the markets we're considering, because we have the support of you guys. One question is about optimizing the last mile delivery to avoid delivery delays. What are your thoughts on that? How have you?
Sorry, I lost it. Say again.
Yes. What about optimizing the last mile delivery to avoid delivery delays? Is this something you're working on? Because this will also expand the operational scalability.
True. I mean, one thing we're surely optimizing is the last mile. It's probably one of the biggest pain points after out of stock that we've been facing. So in order to do that, we have a lot of tech. We have a lot of integrations with third-party last mile players. And of course, integration with the Delivery Hero fleet. So Delivery Hero does a huge chunk, a large majority of their own orders through their own fleet. So that's something that we're able to tap into and leverage in order to make it more efficient and have great operation excellence in the last mile.
Yeah, makes sense. And a crazy thought, I mean, do you think of integrating electric vehicles in the last mile delivery, or is it a bit too soon?
I think it's a bit too soon for drones as well. Also for the cars, I mean, if the cars are electrical, we will use them at this point. But we follow what the market has, the fleet, because it's not our fleet anyway.
Exactly.
We could encourage or find ways to subsidize with banks and so on, but it's not our fleet.
Yes. You have enough problems to solve. You don't want to also create.
Yeah, and also that. Yeah. And last mile is already hard to be profitable, so let's.
Let's leave it. So one final question is, and I think we know the answer, but could Instashop exit bring international focus to the Greek ecosystem?
You could answer that better than me.
Yes, I think the truth is that it has already brought international focus to the Greek ecosystem. We see that. We marketed the Greek factor as much as we could. And we were even in discussions without us bringing it up, in discussions with funds in Europe, for instance, they are aware of what has happened. So it has definitely helped the ecosystem in general, and that's another extra benefit of what you guys did.
For sure. hopefully we'll make it a little bit easier for the unicorn to come.
For sure.
We're looking for it for our own confidence. Because once one unicorn comes, then many will come much easier.
Exactly. I think it's a building process. You've certainly played a huge role in giving confidence both to the entrepreneurs who are starting up, to the investors who now have even more tangible results on their investment. So no, we are all more than thankful and grateful for what you guys have done.
And we are as well, for sure, for VF.
Thank you, John.
Thank you, everyone.
It's been a fantastic discussion. Thank you for giving us your time. I think Alexandros should also be here. And Alexandros and John, since the beginning, actually had met each other, and they had, exchanged learnings and thoughts.
Okay.
So John left.
Bye, John.
He was in a rush to go. But let me also leave Alexander and leave you the floor so that you present to us. Thank you.
Sure,
thank you for being with us.
Absolutely, it's great to be here and to present to everyone again. Really excited about John's exit, obviously, and InstaSwap has been a fantastic result. So he sets the bar very high for everyone else. Hopefully we'll be able to follow that lead. Let me share my screen just to see. I hope you can see my screen right now. Yeah, I think this should be okay. Perfect. Yes, so as I said, excited and honored to present to everyone today. Obviously, 2020 has been a different year for everyone. So in terms of Blueground, I'm not going to share too much about what the company does. We've shared a couple of times more. We basically rent beautifully designed apartments for durations of a month, a year or more. So I want to start the journey of 2020 just reminding us where we were before COVID. So COVID was a really important event for our business and really saved 2020 for us. So if you remember, before COVID, we have been seeing the really, really strong growth. We had about, just looking in February 2020, we had about 3,700 properties around the world, 3 continents and 12 cities. So that was, just growing at 3x year on year. We had reached 100 million, north of 100 million revenue run rate in February. And we had more than 30% gross margin in our mature markets. So business was going really well. We were growing very fast and we were expanding in major markets like the United States. Then COVID hit. So you will see the presentation is really has a big emphasis on COVID because of the impact it had. So for us, COVID was not just in economic crisis. We'd seen economic recessions actually in some of our markets in Turkey at the time of the military coup and all the economic issues that took place after that. We'd seen Dubai is a very volatile market, especially on the real estate side. We're seeing very volatile cycles. Obviously in Athens, when we launched while we're still having economic troubles at the time as a country. But COVID was something more important or more significant. It was a perfect storm for our sector because, as you all seen, travel and mobility were significantly reduced. Constraints were placed, restrictions were placed, and then quarantines around the world, really limiting travel to a very low point. Just as an indicator, we always were tracking the TSA passenger number, which is basically how many people are traveling on planes in the US. And that was down 90% year on year in April. And obviously corporate travel, which is a big part of our revenue, really was frozen at the time. Like all the corporates almost ceased all business travel. So that was really significant for us. And as a result of that change, the demand for our services really freefall. So just as an indication, in April, we were planning to rent an apartment out for about an average in the US, $4,500 a month. actually the price that we're able to get to in that month was almost half of that. So 50% down in terms of rates. The rent cash inflows were down 60% compared to plan. So that was a really significant reduction. So it's actually, we moved in the opposite direction compared to InstaShop, where they almost doubled. We had a reduction of about 50% in rents and rates and inflows. So of course that hit affected our sector. It had a ripple effect across our sector. So there were a number of other companies that felt that impact. So we had, I have here on the page a few of these competitors that have raised quite a bit of money that actually went out of business. So Lyric had raised about 180 million, including quite a bit of money also from Airbnb. Stay Alfred, just to name a few, raised more than 60 million and they also shut down because of the pandemic. There were a few corporate housing players, incumbents like Oakwood and Bridge Street, some older players that really shut down their Euros operation. And in general, every company in the space was really affected. And as I said, unfortunately, some of them had to close down. For us, we had a pretty important and sizable negative impact. Actually, of course, we lost all the margin because of the difference in the rates. But also, the other thing that we had as an issue was that we had just signed a venture debt deal of 20 million that was actually withdrawn from the table because of COVID. So all in all, the impact, I could say, if you combine the gross margin that we lost, plus the fact that we didn't realize the venture debt in terms of a cash impact, was north of 50 million. So it was really, really important and sizable. And we were onto that pretty fast. So we said, okay, in order to change that course and take all of the corrective actions, we actually took actions very, very, very fast. So we had a decisive action plan and we were able to turn around the situation. And this is what we did. So we first started from the top line. Top line was significantly impacted and we saw the enterprise travel really going down. So we had to kind of really adapt very aggressively. And at the time we started targeting new segments. One thing that became evident as the pandemic was developing was that all employers, or a significant percentage of the employers, allowed people to work from home in the beginning, and then this gradually moved into work from anywhere. So a lot of people, especially in the US, that were changing actually their original place of residence and moved to other cities, whether it was for lower cost of rent or they wanted to be away from COVID, as was an example in New York City. So a lot of people actually just started moving from one city to another, and they were looking something more flexible. And then we're able to accommodate and provide this flexible solution that came in furnished and also available for just a few months instead of a traditional 1-year lease. That movement was so significant. Just to share like a bit of some numbers, actually San Francisco rental prices dropped about, in some locations, up to 50% compared to February. So imagine in just like 7 to 8 months, the rent went down in 50%, which typically takes 10 years for that change to happen. The same happened in New York City. So that was one segment that we actually really targeted on, and we did really well. The second thing was, especially at the height of the pandemic, again, mostly in the US, we had a lot of people traveling on the healthcare sector, traveling nurses were able to accommodate that. And also a lot of students, some of the dormitories and some of the different places where they were staying, they were closed to mitigate contagion. So that was another segment we really focused on. And of course, we had to be very aggressive with adapting with our pricing in order to make sure that we adapt to the new reality. That was on the revenue side. On the cost-cutting side, we really took very fast action. We reduced expenses all across the board. We actually dropped most of our offices and everyone was working from home. We renegotiated terms with all our suppliers and subcontractors, and we did a couple of rounds of layoffs. We had to decrease the workforce by about 175 people, and that led to a monthly reduction of cost of about 800,000 per month. That was a difficult time, but something that had to be done in this new economic environment. The other thing that was actually took a lot of time and was probably brought the majority of the savings was the fact that we negotiated really hard with all our landlords. We had, as you saw before, 2,700 apartments. When we started, that number had reduced a little bit, and we restructured all the lease payments. So we got discounts, we got deferrals. So that was a process that took a lot of time, and I think that was something that Blueground did better than any other competitor. And that's why, and as we'll show in a few slides later, we're able to hold on to a bigger part of our inventory. The other thing we did, we pivoted our contract structure. So instead of having leases, we moved into revenue sharing, which basically means that we split the proceeds with our landlords. So, and that effectively hedges from any lease rates fluctuations that happened during the pandemic. So that already we were able to secure about 25% of our US portfolio. That was less important for our Europe and Middle East markets because the impact there was much less. US had a much bigger impact within the pandemic. Actually, in Athens, funnily enough, our rental prices actually grew compared to last year. Probably from all the people coming back from the US, UK, and the rest of Europe, deciding to spend the pandemic in Greece instead, or in Athens instead of staying in their home countries. But I think the important thing that we did, as George and Apostolos mentioned earlier, we were able to close a $30 million funding round. And that allowed us to retain presence across markets. And it was really tough to raise capital in this environment, but it was definitely necessary. And I think the reason that we raised our capital is because we're able to overperform others during these difficult times and be take all the necessary actions to turn around the company. As we're doing all these things, and as we're changing, we're taking all these drastic actions, there was a positive development in the market. Of course, demand dropped very fast, as we saw, and as good old fashion economics dictate, after the demand drops, there is also typically a supply drop. So we saw, as a result from the players come out of the market, as we saw before, but also when we're talking about Airbnb hosts, so that people just moved out their properties from the platform. So the supply of monthly furnished rentals went down. So we saw that across our markets, almost half of the apartments were removed from the market. And you will see on the right-hand side of the page that was a little bit different by city, but roughly about half of the supply was reduced. And as a result, the reduction in supply actually led to the prices going up and then stabilizing. As you see in the slide, from February to April, we had a big drop. April was the height and the lowest price. We're able to get in this again, talking about the US market as an indication. And then we saw that as supply was going down, rates have actually started climbing up. And then in July, we saw the rate stabilizing, and it's been pretty stable since then. So that positive development allowed us to be able to, again, with a combination of discounts that we were able to achieve through the landlord's negotiation, to be able to, again, be generating positive gross margins. And that allows us to continue to operate. And through these discounts, demand uptick, and all the cost cutting, actually, we're able, during the pandemic, to improve our profitability. So we're able to move to, let's say in September, in the slide you see, we had the EBITDA improved a little bit more than 2 million compared to the beginning of the year. And that was a result for all the different things that we did. The other impressive thing, and that definitely goes to the hard effort of that the team put in place, was the fact that we're able to retain our utilization or occupancy. Even in the height of COVID, we never dropped below 87% because we're very quick to adapt, to change the revenue, adjust the prices. So we're able to fill in those units. And as we see in October, we're able to be again at levels that we were seeing before the pandemic. And I think that summarizes this slide summarizes a little bit the impact of what the team actually were able to deliver, which was, we see here our gross margin, which is one of the key indicators for profitability. And you look at the bottom of the page, the gross margin that we had as a plan pre-COVID and what we actually achieved. And we were able to stay very close to target. the reason was that we were really tough negotiators with the landlord. So that really allowed us to, and of course all the other things that we did. And the impressive thing is that in November, we're actually already very close to where our plan was before, because November is a low season in the US, so that's typically a lower gross margin we can achieve. So that was something that kind of summarizes all the efforts that were put in place. And of course, now we've moved, during the pandemic, we're talking a lot about survival. So we've moved beyond survival. We've done all of the necessary changes, cost cutting, adjustment in the model. We've raised a funding round. And beyond survival, actually, this effort has resulted in multiple silver linings. We did realize that we were the best player, at least we're the toughest player in the sector. I mean, we have some of our investors that are having a very good view on the sector. They have reiterated that. Just to give you an indication with Zeus, which again is an investment from Airbnb, we entered the pandemic having less units than them in the US. Of course, as a global player, we're bigger, but we during the pandemic they actually reduced their number of properties quite significantly. They weren't able to keep up with our utilization, so we saw that we gained more ground. We already were doing better because we had done much more with less, but during the pandemic we're actually to even further that distance. Another important thing is that as I mentioned before, we already started moving back to growth. Now in September, October, as you see, we're net positive. We're adding more properties than the ones that we were dropping. We were dropping some of these units whenever we were not able to achieve an agreement with the landlords. And the other good thing is that we introduced this revenue sharing contract structure that hedges any risk from leasing. And that's something that we've been successfully able to introduce during the pandemic and growing into a very sizable portion of the portfolio. That's another important upside from this whole situation. Another interesting thing that we did a pro forma exercise, just looking at how the business would look after all the cost cutting. And assuming demand level goes back to 2019, we think that will be the case in 2021 in Q2 and Q3, or very close to that. Because of course, let's also remember that we are actually in the 30+ day segments. So yes, maybe shorter term stays will be impacted by the fact that more Zoom calls will be done and people will be traveling less for business. Maybe the 1 to 7 day trip will be less than before. But the 30+ day, which is really a relocation, is going to be, we expect it to come back stronger. And even if the market is still a little bit smaller, we still expect the margins to return to the same levels. So when the margins return close to the same levels, we would have been already, if you look at the Q3 with the pro forma results, we've been positive north of $3 million in terms of cash. So that's a good thing to see, that the fact that our cost-cutting measures that we took, and plus with a closer return to normalcy, will lead again to the business being free cash flow positive, even at a $100 million plus revenue level. Other positive notes, we are really, the first thing is we're really focusing on these people, on this trend of working from anywhere. We think this is a great movement, if you want to call it, or trend that Blueground can capitalize on. We're now launching a new product, which is called BG Blueground Passport, where it allows people to give them even more flexibility, so they can change neighborhoods, cities, and they can really take advantage of all the changes that the pandemic has offered in terms of like being able to work from anywhere. We are expanding again. We're doing it in a super capital efficient way with a lot of remote management and very little staff on the ground. We've launched Denver as an additional city in the US. And we're launching Vienna in Q1 and Austin. Again, not really costing us much. We have furniture in the warehouse that we're deploying, and we're using mainly existing resources to launch these markets. And the last, which is more qualitative point, but very important, is the fact that the team has now been much more, it's much more productive and much more cohesive, in the sense that we've been through all these difficult times. And the team is excited and motivated to continue delivering. And that's something that it can only be produced by really going through tough times and adversity together. And then again, as we're seeing beyond COVID, we're seeing again moving back to growth. And the plan is to by 2025 is a little bit lower growth rate than before, but it's still the plan is to make this a very big business, continue growing into the future, and of course we're always going to try to beat this plan. But the idea is that we're now seeing the other side of it and how things are going to develop in the next few years. So this is what I wanted to share with you. Just to summarize, it's been a difficult year, but I wanted to thank Venture Friends and all our investors and the board for being very supportive, especially during some time at the time where during April things were really no one knew how things would develop. And we found a board and an investor group that was really supportive and confident of what we could do, and that's why one of the reasons why we're able to kind of see the other side of that and continue back into our inspiring journey.
No, thank you, Alexander. But I think the board and the investors saw amazing execution and like the drive and the tenacity for you to continue and push forward, and we couldn't have done any other way than support you. And so I have already a couple of questions. One is if you want to share a bit, talk a bit about the geographic split of the 3,500 apartments per regions and cities.
Sure. So about 1,500 is in the US, with the two biggest markets being New York and LA, which have around 300. Then we have about 700 in Athens. Dubai is close to 500. Istanbul is about 400. And then we have about 40 to 50 in London and Paris, just roughly.
Yes. And I mean, there is a silver lining in all this that there is less competition now. But what do you think about whether the market size has changed because some habits may have changed?
Look, I think there's we have to double click a little bit and look into our market. If we look at, for example, Europe, if we look at Athens, honestly, like you look at the numbers, nothing has changed there. Maybe we dropped a couple of percentage points on gross margin, and we took that, and then that came back up. So I think in Europe, what we see, our business is not only we're servicing a lot of clients, not only people that are staying for 1 or 2 or 3 months, but we have people staying with us like for a year or multiple years. And that is the case in Europe for a number of reasons. The fragmented real estate landscape and the fact that it's so difficult, as John was saying before, to rent an apartment, and Blueground makes that super, super easy. So for Europe, I don't see any impact coming out of the pandemic. Again, you could make an argument, maybe you're going to have a few less moves and people staying more remote than doing like shorter trips, but I don't think the 30 plus day segment will be very much impacted. In the US, we did see a much more profound impact of the pandemic, but I think again, because we're talking about 30 plus day stays, I don't think that will be impacted a lot. And even if you want to take the scenario that this goes down by 20 or 30%, still the market size is just huge. I mean, if you think about all our cities, we're subscale. Even Athens, we have 700 apartments. We think we can be about 2,500 there. And all the other markets were really subscale. So even if you think about the 30% lower market share, still the market size is just huge.
Yes.
And we're just in 12 cities right now.
It totally makes sense. And that also probably answers the question about New York or San Francisco, those big metropolitan cities that some people say that might have like a shift of demand. I guess that even if they have the shift of demand, there's still a big enough market for Blueground, right?
Yes. So when you talk about cities, I mean, people moving out of these cities and going to like secondary cities. Yeah, I think at the end of the day, what would happen in this case, and we're seeing it happening, is let's say if New York and San Francisco, I don't think so much for New York, but mostly for San Francisco, if now less people want to live there, and we see that a lot of like, tech leaders or other type of opinion leaders are moving out of the city, of the Bay Area, and even from LA, you might see if there is an exodus, like the overall rental prices to go down. But then for Blue Ground, that's fine, because after we adjust to the new lease prices, then our service is always going to add a margin on top. Otherwise, it's impossible to offer it for anyone. So after this change happens, and we're already seeing in San Francisco right now, where we had the rental prices going down to 40-50%, that prices in December are gradually starting to go up again. So what we need is a stabilization of the price. When we have the price stabilized, then obviously, because our contracts we're renewing every year, then we're able to make this new baseline and then generate margin on top.
Yes, and actually we have had the same experience in the past in Dubai or Istanbul, where we had the shift in the market, and maybe rent levels changed, but Blue Ground was able to always charge this margin on top because of the service we provide.
Exactly.
One other question is about revenue sharing, and which is great in the downturn, but are we leaving money on the table going forward when things turn around?
So revenue sharing, we introduced it in the US. So the split that we have is about 75% to the landlords and 25% to Blue Ground. And that's really close to the gross margin we had anyway. So that will be adjusted. It depends on the city and then the bedroom and the type of the apartment. So for example, if you look at Denver studio, you might need to go to 70-30 or 65-35. But in general, the way we're looking at it is like, does that split give us the necessary margin to be profitable? So we're really trying to mimic almost the lease upside that we had. And if you look at the last year, the gross margin was about 23-24%. So actually, we're going to be a little bit better off. But let's see. I mean, because the objective here is also for the landlords to be able to generate higher than the returns they would make in the market, or at least the same if they would give it in an unfurnished apartment. So you want to be balanced, not get too much, but also not get too little, and you cannot make it. It can be profitable.
I mean, I think the base case scenario here is that we return to some stability with regards to the markets, and then we then charge our margin on top for the service that we provide.
Exactly.
And I think we see that already, right? I mean, those last months we have seen this reversion to the mean, to some kind of stability, despite the second wave of lockdowns.
Yeah, the second wave is, I think people, even though it's actually in terms of numbers, even a little bit worse than the first one. I'm saying I'm looking at the hospitalization because, of course, the cases are much higher, but we do much more testing now. So it's still, people seem to be a little bit more, dealing with it in a different way. They understand it better. We don't have the same kind of panic. If you look at TSA passenger numbers, they were down 100,000 a day in April. Now you're seeing on a daily basis 800,000, even 1 million. In some cases, it's something like 10 times more people are traveling right now compared to April. So people are a bit more sober, if you want, on their reactions. And so I think that obviously is not a great development for most of the businesses, but we see a less impact right now. And the fact that we have been able to, the most important thing now is that we either move to revenue sharing or we rebased our leases to the new level, and we don't see rents going even lower. So that was the main problem, that prices just went crazy down, right? Right now we've adjusted, and we've adapted, so that has much less of an impact for the business right now.
Fantastic. We all look forward to Vienna and Denver and many more cities, and even more flats in London and Paris. Thank you very much, Alexander, for being with us and sharing the positive outlook that we now deserve to see. And with that, I'll now invite Victor to join us for the last presentation.
Hi, everyone.
Hi, Victor. I'm leaving you to do your presentation. I'll join you back for the Q&A.
Perfect.
Great to have you, man.
Thank you. Yeah, good to be here for the first time, I guess. Good to meet everyone for the first time. Victor, dialing in from London. I guess I'll run through kind of a background on Plum, given it's the first time we're presenting here, and kind of what we've done to date and what the future holds, right? So There we go. So Plum today. So Plum effectively is the financial assistant that helps you have more money for free, right? And all you have to do is connect your bank account. We started on this journey in 2017 because we think people have like a major problem with money, right? They don't have enough money right now, and they won't have enough money in the future. I think that the figures that like really drive us in our mission is that, you know, as we see here, like a lot of people are stressed about not having enough money. A lot of people lose money on bad deals, right? And 100 million people in the UK have like less than 3 months of savings, right? So people aren't really saving. And then people that are saving are not really doing a good job at their savings earning a return, right? So as you can see here, like, you know, we have like 5% of people saving up for retirement and 97% of people, their savings earn less than inflation. So I guess the solution to the problem, we believe, is driven based on data and automation, and that's what drives the product. So you link your bank account to Plum. Based on the data we see, the first thing we do that has an immediate impact on you is we detect all of the bills that you're overpaying on and recommend alternatives for you, right? So we detect that you're paying British Gas, and then we'll recommend that you can use one of our partners and save like £300 in a year. That adds up and is also very immediate impact on the user. And I guess our goal is to make that journey very simple so that the people take that action. The second thing we do is that from the point of like you signing up, we have an algorithm that looks at what goes in and out of your account, and that algorithm then starts saving money for you automatically. So you don't need to tell the algorithm how much you want to save, but it will detect how much it believes you can save, and it will save for you every week an amount that it believes you can put aside without feeling the impact. And also will adjust that as your spending increases or decreases throughout the month, right? So we really wanted to build this piece of the product because we wanted to have something that was a zero barrier to everyone to save. Now, the last piece, which is also a critical piece of the equation, is how can you grow your money? So you start putting money aside with Plum, but now you can also open an investment account with Plum where you can start investing and growing your money. And what we've done here, which is kind of different to what's been happening in the industry with robos, et cetera, is that we also have thematic funds. So we allow people to invest in tech companies through our tech fund, which means that they get exposure to Netflix, Apple, Tesla. And those are things that I guess get people a lot more excited about investing. So effectively, like the area that we think we want to dominate as a company is that Plum equals save, right? So there's no company in the world and in the UK, in Europe specifically, that owns the saving space, right? Which is this assistant that is helping you effectively have more money and you not needing to have to worry about it. And that's what we're building. I guess in the last year, we've had a very exciting year, right? It's a bit technical what happened in October, but like we moved to open banking. So this is the new protocol that allows you to connect the banks. We launched on Android. We used to be a Facebook chatbot. Now we're only on the apps. We launched our Pro tier, which allows people to subscribe for $2.99 and get additional savings features. We launched faster payments, which sounds very technical, but also allows you to move money into Plum instantly versus open banking. Payday allows you to save. So we also build a lot of like additional saving rules. So we're a very product heavy company. So we detect your income and we allow you to save on when you get paid. Diagnostics allows you to see how much you're spending on certain categories versus people in your income income bracket and geographical area, right? So I know that if I'm earning 50K, other people spend this much on rent versus I'm spending 10% higher, 10% lower, right? In June this year, we allowed people to connect all of their bank accounts into Plum so they could see what was going on. We also launched something called Cashback, so you can like choose buy intelligent offers of Plum and reduce your cost on like day-to-day spend. And then we also launched our FSCS protected account so that people can now earn interest on the money that they're saving with Plum. What has this meant is that we're currently at around 1.2 users that have like registered lifetime onto Plum. Up till now, we've saved 310 million pounds for our users, and that like doesn't really compare to what the run rate is. Right now, we're saving around 30 million pounds a month for users. So we see that this will extrapolate a lot, and we have 80,000 people that are now paying a subscription to us. In the next year, we'll be launching in Europe, and then by 2024, we will hope to be in like 10 countries, a lot more countries in Europe, and maybe beyond. The way we grow, because we're a consumer-facing product, is we grow by a combination of paid referral, but also organic. And I think here what we've been really enjoying is an increase in organic growth, given that our brand is becoming a lot more familiar in the UK ecosystem, and as our product is developing, it's a lot more powerful proposition for people to connect their accounts and use us. So I guess where we think what we're doing and what we think we're building, the core focus right now is on European expansion, on our proposition of Lost Money, which is the switching proposition, on launching pensions, which is an additional investment product, and also giving interest on savings, which we already launched, but we're enhancing. In terms of Europe, we're going to be launching in Ireland, France, and Spain. These are actually in beta right now, but we will be releasing them more thoroughly. We believe Europe is really interesting because there's a savings culture, but there's also a terrible kind of investing culture, right? And we believe with the product that we've built, we'll be able to really unleash a product that's very low cost for a user to test investing, and will really be a proposition that is that can grow quite quickly. Lost Money is the bill switching that I mentioned. So we've been very successful with energy, which we've had live for a while now. So we detect, as I said, who pays an energy bill. We make £50 if we successfully switch someone, and then the users will save like somewhere between £200 and £300 over a year. We're doing this across other categories, like we're doing that for broadband. We're doing it for loan consolidation, for credit cards, and also insurance, which includes car insurance and other products. Pensions is going to be a huge, and very valuable, lifetime value product for us, because right now 75% of Brits have pensions with multiple providers, and there's no way for them to consolidate and take control of their pensions. There's been a regulation that's changed recently that means that everyone in the UK now has a pension. So 10 million new people have entered the market, and as these people move through different jobs, they'll have different pots of pensions. And the contribution to these pensions is quite significant, and this will be a product that we'll be launching in the new year, and we'll be looking to capture quite significant AUM. The last thing that we've done and we're keep improving on is giving kind of best-in-class interest rate to our users, right? When we had launched, we weren't getting interest for our users. We've now integrated with some partner banks, which allows us to pay interest on your deposits. The absolute numbers are low, but I think what's important is that they're the highest, close to the highest in terms of interest that you can gain in this current interest rate environment, right? So I guess effectively with all of these propositions, we want to build best-in-class products so that people can't get a better deal anywhere else than in Plum, but also build this functionality that brings intelligence over your finances. So if you think of 2021 and beyond, this is kind of how we think of the proposition, with kind of bringing your whole financial life together, right? You can connect all of your financial life, but then the automation is helping you save money, invest it in shorter term investments, but also even your pension, right, will be with Plum. Lost Money is making sure that on the cost side, you're not losing any money. And then finally, we're also looking to potentially launch a card that will allow you on the day-to-day spend to save by deals that we have on cashback, also budget onto that card, and in the long run also allow a lending proposition. Just a very brief thing on the people behind Plum, given it's the first time that we're talking. We've started building quite a significantly strong team. I used to be one of the early employees of TransferWise. Our head of marketing used to be head of marketing for Uber, paid marketing in Latin America, and was recently at Revolut. He joined us. Kish is one of our designers that was with me at TransferWise and built the whole product there. And then recently we've also hired Charlie, just highlighting a few of the people here, that was head of partnerships at ClearScore, which is a 12 million user company in the UK that does effectively switching. as a business, Venture Friends was the first institutional investor that we got in. And thanks to them, more people had given their trust to us. But it was great when they trusted us. With the first institutional round that allowed us to build what we're doing here. We've raised 14 million to date, and there's we're a very product heavy focused company. And we keep executing on the product. I guess that's our focus and expansion. So that's Plum. And that's the summary of effectively what we've been doing.
Yeah, well, Victor, I have to say thank you for the presentation, first of all. What you just described as seems amazing, and it's such a long way from when you started like a couple of years ago.
Yeah.
You have built like a product that is really impressive, and you did it with very limited capital compared to other fintechs. That's one thing that is we really feel it's amazing. Most fintechs have raised a lot of money, they have no revenues, but I think you managed to keep a balance and they have some decent revenue without spending too much capital.
Yeah, I agree. I mean, it's interesting, right? Because I think we had a board that was more revenue focused than other potentially boards that were willing to kind of spend more, and I think that's ended up being beneficial to us, right? Like I think we did focus on revenue in a way earlier. We took some bets with subscription that worked out and continue to contribute. But I think you're right. Like with the capital, I guess we've managed to hire, I think, people that know the industry and build quite fast, the proposition.
Yeah. One question asked is how scalable is it to expand in Europe versus the US, given that there are different rules and regulations?
Yeah, good question. The regulatory piece is one that you need to tackle, right? But from a platform perspective, we have like 4 core things that we require, let's say, to give an initial product, right? The one is the banking connection, right? And we're with a partner called TrueLayer. They're across Europe, so it means we can kind of turn on Europe. We have a provider that allows us to move the money called GoCardless. They're also across Europe and the globe, right? They're in the US, they're in Australia. So we can turn them on. And then we have an e-money provider, which is the provider that holds the money that is also in the UK and in Europe and is looking to expand they've expanded to the US and beyond. So from a technical perspective, right, we're able to turn on these jurisdictions. Typically, when you expand from a regulatory perspective, there's things that we need to get our own regulation for, right? And there's things that we can rely on others, right? So in the case of like the holding of the money, we still rely on our partners, which is Railsbank for the regulatory coverage is an e-money license, right? In the UK and Europe, we'll be looking to get our own license, right? But then for the investment piece, we need to get our own license to be able to talk to users from the investment side. I would say it's like, it's a lot easier because we've chosen our partners carefully and they have both capabilities and licenses in these countries, but it is the thing that has the biggest lag time in order to be able to expand, which is also makes it very defensible once you do. Yeah.
Makes sense. And with regards to your competitor environment, who do you view as competitors?
Yeah, I think we've been through a history with this, which I think is now the most favorable time we're in, right? Like when we started, clearly neobanks had raised a lot of money, and neobanks had said that they will do a lot of what we did, and some of them have done parts of what we've built, right? But I believe now, at least in the UK, with like Monzo, Revolut, and Starling, the market has realized that they are doing transactional card, that they will have an investment product, etc., but their primary focus is a transactional card and maybe lending, whereas you do still have the need for this layer on top that brings your money together and helps you with the savings and investment. So I think we've kind of distinguished ourselves from neobanks, which was before like considered a competitor, and now it's, I think, less so. In Europe, we don't think there's anyone that's doing this holistic proposition. In the UK, there's a company called Moneybox that has started as an investment proposition, has a saving proposition, but they don't have this holistic component as us. When we started there was a company called Clio that had launched, but now they've launched in the US and their pure focus is on the US. And as Apostolos have shared many times, like their volume of downloads in the UK has like kind of completely diminished. And then there's a company that's never raised the VC round called Chip that is very slow in product development, keeps raising crowdfunding, but we believe we have a much superior product. So we think product-wise, there's a lot of opportunity because what we built it doesn't really exist in a lot of, there's not companies that do exactly what we do.
Yeah, and just repeating a question that is, who is deciding on which funds to invest?
Yeah, so we use trackers. So we don't use actively managed funds. There's still a decision process internally, but like we basically, the fund selection is we have 3 funds that are diversified, so high, low, medium risk. We've chosen some Vanguard life strategy funds that have 80% equity, 20 bonds. These funds, like we've chosen them because they have a very low cost, like they charge 22 basis points to manage your money in like these growth balanced or like, conservative view. And then we've also chosen trackers in areas that we think are important. So we have a tech fund, we have a S&P fund, a UK FTSE fund, a European DAX fund, and then we have like a clean energy fund, etc. We have a total of 9 funds. We don't want to expand that too much because we think that's our like kind of a wealth product. So we don't want to like over confuse people, but in the future we'll be trying to launch a stock trading proposition as well, so that some people that want to become more active and more adventurous can choose like individual names like Apple, Tesla, etc., which are quite popular these days. But also they might be able to choose other like ETFs that we offer through the market.
So one other question is, what's the 3-year goal for Plum, or even 5-year goal, like sell, IPO, merge?
No, I think like I never understood why people said they wanted to IPO or whatever, and I guess I had the experience of TransferWise as well. I think for us, I think my philosophy is as long as we're building something that we don't feel other people are able to build or building at the speed that we're building, there's no reason to consolidate with anyone. And I think fintech is at this great, I think building product in fintech is now what like differentiates you. So we'd like to remain an independent company, I think, forever, right? If we can, I think we've built something unique, and I think you need that independence to continue innovating. So we like to be independent. If we IPO, fantastic. It sounds like very far away right now. It's not what like we're trying to do, but we're trying to build a very big business that dominates UK and Europe in the like save and investing space.
No, makes sense. One other question is from an AUM perspective, is it feasible to keep growing organically, or do you think you'll eventually have to partner with institutions that already have the AUM, if AUM is a top KPI? Yeah,
it's not a top KPI. I think like we think in terms of users, right? But then users definitely bring variant amounts of AUM. So we would partner with institutions that bring us users, right, that have AUM. That would be attractive, but I don't think we'll ever be managing institutional money on behalf of like, I don't know, like a pension provider or something. Our business would be to onboard those users, and whatever AUM they bring with them, we would take.
Yes. And one other question about the fintech landscape. So there are robo-advisors, neobanks, personal financial advisors, e-cards, everything trying to get into each other's turf. How do you see the fintech environment in the future? Do you expect consumers to have one app or have several apps for different reasons?
Look, I think consumers will always have multiple apps. I think they will have fewer apps though, right? I think it's a mindset thing, right? Some people like to keep their finances separated in different places. Some people want to have one app. I believe there will be some big winners that will have a holistic view on people's finances and a holistic view of their like wealth and control of their wealth, right? Because they'll build a convenient product that will be that. So I think, and we want to be one of those players. But what I would say is, I think my view is that you will have, I think the big companies will be the ones that try to be like more holistic, right? So I think you'll have some neobanks that are quite large and do well. I think you will have some companies like Plum that kind of capture, I guess, the non-transactional volume of a user, like the savings and the investments at scale, like mass scale with very small users, and kind of give people this advisory layer on top. And I believe robo-advice, for instance, is a commodity, and you see a lot of these companies are already doing B2B deals where they will provide infrastructure maybe for a neobank or a Plum to have a portfolio. But I believe on the consumer front, you'll have these larger companies with more users and more services, but there will be standalone specialists. It's never like, I think, one thing, but I think the guys that are holistic are the ones that can win, because we can build top class products within the various categories, given where the financial ecosystem is, and kind of the API companies that exist that allow you to build quite good product without being, hyper specialized in that domain.
Fantastic, yeah. Victor, thank you very much for the presentation and the discussion. You're in a fantastic space, and it's great to see that Plum is gaining ground on consumers' minds. In the